Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, December 10th. Chinese stimulus hopes are driving tactical longs back to Chinese assets. Gold is gaining on reports that the People's Bank of China has resumed increasing its gold reserves after a 6-month pause. And Nvidia is under a renewed downside pressure following accusations of violating China's anti-monopoly rules in a 2020 deal. In short, today is all about China and its fight against economic headwinds and rising geopolitical tensions. So this week started with a flurry of news from China, really. First, sentiment in Chinese equities reversed suddenly yesterday to a significantly more bullish state after the Politburo of China, which is the country's highest decision-making bodies within the Communist Party, pledged to embrace a moderately loose monetary policy in 2025. So this is a meaningful dovish shift from the prudent stance of the past 14 years for the People's Bank of China, hinting that further interest and reserve rate cuts are on the menu of next year in China. Now, some said out there that this was the most aggressive dovish tone in a decade. As a result, the Chinese 10-year bond yield slipped to a record low level, and the Chinese equities jumped more than 3% at today's opening, although they gave back some of these gains. Now, all eyes are on the Central Economic Work Conference of China, where the Chinese officials will be discussing behind closed doors and could eventually complement the monetary support from the PBOC with the much expected fiscal support, ideally a massive one, and ideally with a price tag on it. Now, of course, it is very, very tempting to jump in and buy the Chinese assets at significant discount level before the rally takes off. Alibaba, for example, jumped more than 7% on the news yesterday in New York trading, or if you prefer, and the company is down by 70% since its 2020 peak. And its PE ratio is just around 12 right now. That's very low compared to Amazon, for example. Its American equivalent that trades more than 46 times its own earnings. And remember, a violent crackdown on Chinese big technology companies and slowdown in the Chinese economy have taken a toll on these once admired Chinese big technology companies, and it will take more than a few stimulus measures, in my opinion, to revive appetite for these Chinese stocks. It will at least take a few good economic reports, for example, to convince investors that what's being put in place by the Chinese government and the People's Bank of China is bearing fruit. For now, we are not there just yet, after yesterday's data showed accelerated consumer deflation in November in China. Well, the trade data released today also pointed at a sharp slowdown in Chinese exports. Growth there almost halved compared to the figure that was released a month ago, while imports fell nearly 4% in November compared to the same time a year ago. So it's needless to say that this is not the kind of numbers that you want to see when you go back into the Chinese stock markets in the middle of a chip and a trade war. They're not going toward the right direction when the geopolitical tensions start rising as well. As such, the Chinese stocks could, be a good tactical trade for those who love the meme-like intraday volatility, but I would personally be careful to enter a longer horizon position for now, as 2024 was marked by stimulus hints from China that led to a market rally and then resulted in disappointing stimulus measures and a sell-off. Maybe this time is a charm, but we don't know that. Let's see, because tensions with the US are mounting these days as Chinese authorities are putting fuel on the fire. This time it's them doing it before Trump's official start date, even though, yes, Trump's term has clearly started even before his own election. So in this context, Chinese companies reportedly cut off key supplies to the US and to Europe that are necessary to build unmanned aerial vehicles, for example, that Ukrainians use in their war against Russia. And the country opened a probe into Nvidia, accusing the company for breaking their anti-monopoly laws in the acquisition of Mellanox Technologies back in 2020. And that could cost Nvidia as much as 10% of its prior year revenue. So Nvidia shares took the hit yesterday. They fell 2.6%. But the good news is the part or the percentage of Nvidia revenues that come from China has more than halved since a couple of years ago compared to 2021, for example. And being left in the crossfire is never good news, obviously, but the impact of the additional events from China will decreases as the company gradually steps out of market that's obviously once been so promising and so lucrative. But that's life. What do you do? In other China-related news today, well, gold is up these days after a few stagnant weeks on news that the People's Bank of China resumed buying gold after a 6-month pause, certainly to back a looser monetary policy in 2025 and maybe also to decrease its exposure to US Treasuries. So the price of an ounce is testing the 50-day moving average, offers to the upside right now. That's near $2,700 per ounce level, with potential to extend these gains on the back of strong global political, geopolitical, and economic uncertainties that we have on the headlines these days. Crude oil, on the other hand, remained capped into the $69 per barrel level at yesterday's rally. That was fueled by Syrian uncertainty and also hopes of Chinese stimulus. Now, the oil bulls' inability to capitalize on this mix of geopolitical tensions and economic optimism from China underscores the prevailing strength of the bearish tide that we see in the oil market today. As such, a further sell-off toward the $65 to $67 per barrel range is certainly plausible. Elsewhere, well, iron ore extended its advance to a 2-month high today on the back of this Chinese stimulus hope, but reversed the early day gains, while the Aussie dollar couldn't benefit from these Chinese stimulus measures or the Chinese stimulus measure hopes, as the Reserve Bank of Australia kept its policy rate unchanged at today's meeting as expected, but officials there sounded more dovish than expected, because they said that they are now gaining some confidence that inflation pressures in Australia are easing. As a result, the Aussie bulls may be losing an important ally, but the Reserve Bank of Australia's hawkish stance so far did quite little to limit the Australian dollar sell-off. So therefore, I think that the Chinese news, or more specifically, the Chinese ability to boost growth in their country, will be more important to the Aussie than what the Reserve Bank of Australia decides to do. Elsewhere, in the FX markets, the US dollar extended gains at yesterday's trading session, and the move yesterday was mostly driven by a flight to the dollar's safety. The euro dollar saw support near the 105.30 level on Monday. The dollar yen is preparing to test the 50-day moving average to the upside, so that's near 151 level, and cable is flirting with the 1.28 offers. While the Bank of England's more cautious stance due to the British government's pledge to extend spending to boost growth in the UK looks supportive of the pound. The negative impact of the tax rises there to finance all that will be felt before the positive impact of spending on the economy, and that's already being felt. And that could convince the Bank of England to adopt a more supportive policy on the monetary front and cap sterling's upside potential against the greenback. But I believe that the pound should remain bid against the euro, aiming a further advance toward the 82 cents level in euro pound, as the US tariffs are expected to hit the EU economies more than they are expected to hit the UK's. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market commence. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I won't meet you tomorrow, but I will be posting the Fibonacci video and I will be meeting you the day after that, the day after we are preparing and shooting the 2025 market outlook for you guys. And until then, good day trading.